Welcome back, fellow traders, to a new video of Timo trading techniques. In today's video, we will explore a new trading technique with only one indicator using trend lines and watch out for breaks, simple as that. Although very simple and easy to implement, this technique can be very lucrative. We will also be testing out the strategy in a live backtest at the end of this video to get an idea about what profits to expect. Without further ado, let's dive into the strategy and see what is it all about. First, we add the indicators for this strategy. We go to TradingView and click Add Indicators. Then we type trend lines with breaks. It is an indicator from the Lux algo, and we add it to our screen by clicking on it. After we have added this indicator, we go to settings of the indicator and change its length to 24. We also change the slope to 1.6. We leave the rest of the settings on default. We are now ready and prepared to execute the technique. We will start by taking an example of a long position. It is important to keep a few steps in mind. Step 1. Find a good entry position. To find a good position to enter the market in a long position, we only have to look for green descending lines made by our indicator. Whenever we spot such a line, we wait for a buy signal to appear. These signals will appear in the form of a green B. When a candle with such a signal closes, we can enter the market in a long position. Step 2. Place stop loss and take profit levels when we have taken a position. We have to choose a stop loss level. This can be done in two ways, and it depends on the situation at hand. In this example, we see two long positions have been taken. In the first long position, we see our stop loss level has been drawn slightly under the green descending line. We chose this level because price has already moved relatively far away from the green line when the candle closed, and we took our entry. In the second long position, however, we see that price did not move as much away from the green line. In this case, we opt for a stop loss level slightly below the last low. Once we have chosen our stop loss level, we now are set to choose a take profit level. We simply do this with a risk-reward ratio of 2. This means that the distance from our entry to our stop loss level, also called a risk unit, is doubled to the upside starting from our entry position. In other words, when price does not move as we would like to, and our stop loss were to hit, we lose 1 risk unit. If, however, price does move as intended beforehand, we gain 2 risk units. As we can see in this example, we gained 4 risk units by taking 2 successful long positions, netting us a nice profit in the process. I also want to mention the optimal time frame for this signal strategy. After many weeks of backtesting this strategy thoroughly, we come to conclude that the 15-minute time frame works best for this strategy. You may be asking yourself if this strategy is profitable over a long period of time. We will see in a moment if and why this strategy really works by doing some live back testing over a longer period of time after we have watched a short example. In the next example, we will study a short position. The steps are the same as for a long position, but in reverse. We first look for ascending red lines and wait for a crossover of this line. Whenever a candle closes under this line and we get a red bed signal, we can take a short entry in the market. We also see that in the first case, we did not wait for a B signal. It is possible to enter the market with this technique whenever we see price moving clearly away from our descending green or ascending red lines, as is the case here. After we have taken a short entry, we chose our stop loss level and take profit level with a risk-reward ratio of 2. Once more, we see some nice gains here. Now we finally put our technique to the test. I will also, as usual, fast forward so we can see the results more quickly. In a period of 1 month, we found us 27 trades. Of those 27, only 13 were wins and 14 were losses. This makes it seem like the strategy is bad, but keep in mind, we took a risk-reward ratio of 2. By taking this into consideration, we actually end up with a nice return on investment. We had 13 wins, and multiply those by 2 minus our 14 losses, which leaves us with a positive net result of 12 risk units. A risk unit is a fixed amount of money you are willing to risk every trade. If, for instance, we were to risk $100 every trade, we would have gained a profit of $1,200. Although the rules and the technique are rather easy, there is clearly some nice profits to be made. And the best part of it all, you could do it too, just by following the steps explained in this video. I want to thank you for tuning in, and I'll see you soon with more profitable and easy techniques. Also, if you like our content and want to see more of these trading strategies from Timo Trading Techniques when they are posted, please click the subscribe button below.